Welcome back, everyone. We have officially arrived at the final milestone of this chapter, Module 6. This session is designed to serve as your ultimate final exam workbook. We are going to consolidate all the core accounting knowledge we've built across our first 5 modules, jump into high-probability examination questions, and master the exact step-by-step model answers you need to ace your tests. Let's finish this unit strong. Let's start with a rapid-fire recap of our core structural frameworks. Remember, an accounting system isn't just about math, it is a structured process that identifies, measures, and communicates financial data. It moves sequentially through 3 stages: inputting raw economic events, processing them through journals, ledgers, and trial balances, and generating the final statements. We also explored the 4 primary business structures, ranging from small sole proprietorships up to massive public limited companies, and identified the key internal and external users who rely on this exact reporting to make multi-million-dollar decisions every day. Moving on to compliance, we summarized the 13 foundational accounting principles that govern our bookkeeping, such as separate entity, accrual, and the concept of prudence. These principles feed directly into formal accounting standards, which are legally mandated rules designed to harmonize diverse accounting treatments. We took a specialized look at IAS 20, which defines the precise math behind calculating basic and diluted earnings per share. Ultimately, management professional must use these frameworks to select the right internal accounting policies to reflect a true and fair view of corporate performance. Now, let's pivot into our workbook questions. It's time to test your conceptual understanding. I want you to pause and think about these 3 high-probability exam questions. First, can you clearly break down the structural difference between a revenue reserve and a capital reserve? Second, how exactly does the going concern assumption dictate how we calculate asset depreciation? And third, why are companies legally obligated to explicitly disclose any change in their internal accounting policies? Take a moment to form your thoughts before we move to the math. Let's add some numerical and rule-based application to the mix. Question 4 presents a classic inventory valuation scenario. A company purchases raw materials for 40,000 rupees, paying an additional 2,000 rupees for freight inwards and 1,500 rupees for freight outwards. Your task is to calculate the total cost of purchase to be reported under Accounting Standard 2. Following that, question 5 tests your memory of compliance metrics. Can you define the exact denominator rules used to calculate basic earnings per share under IAS 20? Let's check how well you scored. Let's look at the model answers for our first 2 theory questions. For question 1, the critical distinction lies in the source and usage. Revenue reserves are built directly from standard, daily operational profits and can be freely used for any business purpose. Capital reserves, however, are built from non-operational capital gains and are strictly restricted under corporate law. For question 2, because the going concern principle assumes our enterprise will run indefinitely, we record assets at their historical cost and systematically depreciate them over their useful lifespan, completely tuning out short-term, unpredictable market price fluctuations. For question 3, the explanation ties directly back to consistency. The consistency principle requires a company to use uniform accounting methods year over year so investors can accurately track trends. Because a sudden shift in policy, like changing your depreciation framework, can dramatically manipulate and distort the reported net profit lines, full disclosure is legally required. Quantifying and detailing that change in the financial notes ensures investors are not misled and preserves transparency. Let's break down the math for our inventory problem in question 4. Under Accounting Standard 2, the cost of inventory includes the core purchase price and all expenditures directly required to bring that material to its present location and condition. So, we take the 40,000 rupee purchase price and add the 2,000 rupees of freight inwards, giving us a final inventory cost of 42,000 rupees. But watch out for the trap. The 1,500 rupees for freight outwards is a selling and distribution expense, meaning it hits the income statement immediately and is strictly excluded from inventory value. Now for our final application answer regarding IAS 20. When calculating basic earnings per share, the denominator must strictly represent the weighted average number of equity shares outstanding during that specific period. This isn't just a simple count, it requires a time weighting factor. New shares issued for cash are only counted from the exact date that cash is receivable, and shares issued via debt conversion are factored in from the formal conversion date. This ensures the denominator accurately reflects the timeline of capital usage. That brings our frameworks, principles module and the completion of this chapter. Congratulations! You have officially navigated and unlocked all modules covering the basics of financial accounting. Thank you to everyone. If this session helped, please take a quick second to hit that like button, share this lecture with your fellow MBA or business classmates, and click subscribe to our channel, Common Center.